All right, let's jump straight into the defining paradox of this whole AI boom. We all know generative AI is revolutionary, right? It's literally changing the world overnight. But here is the multi-billion or really trillion-dollar question. What happens when the massive tech giants currently spending hundreds of billions of dollars on AI infrastructure stop buying third-party chips and just start making their own? I mean, these companies are deploying capital at a scale that eclipses the GDP of many developed nations purely to stockpile compute. So today, in this explainer, we're unpacking a massive structural shift. We're looking at how NVIDIA's historical premium is starting to evaporate and why we are officially entering the commodity era of AI hardware. So, here's our roadmap for the day. We're going to start by breaking down the architecture of a monopoly, then we'll look at the hyperscaler mutiny. From there, we'll dive into the deflationary hardware curve, look at some pretty terrifying historical echoes, and finally, untangle the difference between a great technology and a brutal stock.
Okay, Section 1, the architecture of monopoly and analyzing that NVIDIA premium.
To really understand why this premium is collapsing, we first have to appreciate the sheer scale of the peak. We've basically been living through a period of frantic scarcity, where general-purpose GPUs had absolute monopolistic pricing power. Just look at this number, 71.07%. That was NVIDIA's trailing 12-month gross margin as of early 2026. Actually, it even peaked near 76% back in late 2024. Just let that sink in for a second. Over 70% margins on physical hardware. This level of profitability was sustained entirely by panic and scarcity. Every single company on the planet needed to scale large language models to survive. And for a brief window, there was literally no alternative to NVIDIA. But underneath that towering margin, the foundation is shifting fast. Because the truth is, that premium is incredibly fragile. When you break down the manufacturing costs, you see a massive structural shift in the bill of materials. Look at the share of costs going just to high bandwidth memory, or HBM. It was 41% of the H100's cost, 45% for the B200, and it's projected to eat up over 50% for the upcoming Vera Rubin chips. It's kind of like building a luxury house, right? If the cost of the raw materials, the lumber and the concrete, suddenly shoots up, your profit margin gets squeezed from the bottom. Plus, base wafer costs at foundries like TSMC are hitting around 30 grand for 2-nanometer nodes, so there's a hard rising floor on input costs here. This means when supply inevitably catches up to all this manic demand, those 80+% implied margins, they really have nowhere to go but down. Moving right along to Section 2, the hyperscaler mutiny, custom silicon entering the chat. See, the biggest catalyst for this margin collapse isn't just supply catching up, it's a fundamental shift in who is actually making the chips. Projections are showing a catastrophic decline in NVIDIA's market share for AI inference. Back in 2024, NVIDIA practically owned the whole space, right? 87% revenue share. But look at the projections, a drop to 75% in 2026, and an absolute free fall down to 20 to 30% by 2028. Why is that happening? Well, because the Mag 7, Alphabet, Amazon, Meta, Microsoft, they woke up and realized that paying a 75% markup to a third party is completely insane when you're projecting over $600 billion in combined capex. At that scale, if you save even 10 or 20% by making the hardware in-house, you're saving tens of billions of dollars. They're going from being NVIDIA's best customers to its absolute worst nightmares. And these in-house chips, these ASICs, they aren't just cute little science fair projects anymore. They are absolute powerhouses. Take Microsoft's Maya 200, built on a 3-nanometer process with 140 billion transistors, pushing over 10 petaflops in low-precision compute. The strategic value here is a total game changer. Microsoft is reporting 30% better performance per dollar than off-the-shelf hardware. Or look at Google. Their TPU V7 is nearly at parity with NVIDIA on inference, and it's literally cutting monthly compute bills for some clients from $2.1 million down to just 700 grand. That's massive. Every single query run on this custom silicon bypasses NVIDIA entirely. All those savings go straight to the hyperscaler's bottom line. All right, Section 3, AI's deflationary hardware curve, or what analysts call the 180-degree angle. We really need to unpack the underlying physics of this market shift. There is this huge misconception out there that massive capex spending means hardware values will stay permanently high. But that ignores the fundamental deflationary nature of AI. Traditional tech usually just digitizes manual work, right? But AI actually optimizes the work itself. For hardware, this creates disinflationary growth. Think about your smartphone. It completely absorbed the need for a separate digital camera, a calculator, a flashlight, a GPS, permanently destroying the demand for all that separate hardware. AI hardware does the same thing to itself. Every new generation of chips is so much more efficient that the older ones become obsolete instantly, heavily reducing the total volume of hardware you actually need to buy. And we can see this mechanically playing out right now with the shift to low-precision formats like FP4. Let's just look at the math here. It's wild. Compared to the older BF16 format, FP4 quadruples the throughput to 1,440 petaflops. But at the exact same time, it slashes the required memory footprint down to just 25%. So you are doubling performance while having the footprint. Think about what that means in the real world. If your new chip takes up a quarter of the memory to do 4 times the work, you simply do not need to buy as many physical chips. That puts an immense deflationary weight on overall unit demand. This whole transition perfectly maps to the shift from the training era into the agentic inference era. Training in AI is like building a massive library from scratch. It takes brute force compute and extremely expensive general-purpose GPUs. But inference? That's just looking up a book in the library once it's built. You don't need a supercomputer for that. And by 2026, 60 to 80% of all AI compute is going to be dedicated purely to inference. Inference is all about efficiency, speed, and driving down the cost per token, which heavily favors those custom ASICs built by the tech giants. So the crazy irony here is that the AI technology is succeeding wildly, but that exact success is destroying the hardware margins that fueled the hype in the first place. Oh, and that protective software moat NVIDIA had? It's breaking down too. Look at OpenAI's Triton compiler. For years, NVIDIA's CUDA software was an impenetrable fortress that locked developers into their hardware. But Triton acts as a literal CUDA killer. It lets developers write code in standard Python and magically achieve parity across NVIDIA, AMD, and Intel hardware without constantly intervening. It just works. It strips away the friction of switching to cheaper hardware and effectively turns the underlying silicon into a totally interchangeable commodity. Section 4. Echoes of historical crashes. Let's look at the short-form pivot. To ground all these numbers in reality, we have to look back, because commodity crashes always follow a predictable mechanical curve. The 1990s memory and hard drive markets tell a really sobering story here. We had exponential growth from the PC revolution. By '99, there was just sheer panic buying. Everyone was on allocation, meaning nobody could get enough chips. But what really happened? Companies freaked out. They double, sometimes triple ordered parts just to get in line, which created this massive, completely artificial demand signal. The manufacturers saw that, built a ton of new factories, and boom, massive oversupply hit, and within a few years, hardware margins entirely collapsed. We've seen this exact cycle before. And if you want a terrifying quantitative parallel, look at Cisco during the dot-com boom versus NVIDIA today. Cisco built the physical infrastructure of the internet. NVIDIA is building the physical infrastructure of AI. Cisco peaked with a price-to-sales ratio of 40x and a forward PE near 200x. NVIDIA's speculative intensity is remarkably similar. Now, when the dot-com bubble burst, telecom companies realized they'd wildly overbuilt their fiber networks. Cisco's actual revenue was fine over the long run, but their pricing power evaporated overnight. The stock lost 80% of its value. The huge takeaway is that even absolutely perfect execution from a company cannot save a stock valuation that's built on the assumption of a permanent hardware monopoly. Which ultimately brings us to the cold calculus of the commodity hardware market, 20 to 30%. That is the normalized historical margin for essential hardware. The brutal truth of the tech industry is that when a foundational technology becomes truly essential, like RAM or routers or hard drives, its price relentlessly falls to allow for global adoption. Silicon scarcity is turning into silicon abundance. Economic gravity is undefeated, and it tells us that NVIDIA's 70+% gross margins are eventually going to be dragged right back down to this 20 to 30% historical mean. And finally, Section 5, Great Tech, Brutal Stock, the $600 billion question. This is where the financial reality gets pretty brutal, because investors constantly confuse a world-changing technology with a guaranteed winning stock. The systemic risk holding these hardware valuations up is staggering. Yes, hyperscalers are projecting over $600 billion in AI capex for 2026. But look at the customer concentration. In fiscal 2026, 36% of NVIDIA's total revenue was tied to just 2 individual companies. 2. That is a highly vulnerable, zero-sum game. If Microsoft or Google signals even a tiny pause in spending because their in-house chips are handling the load, GPU orders will crater. Losing just one major buyer is a disaster for a stock priced for perfection. We're even seeing weird circular financing, where hardware providers invest in AI startups just so those startups turn around and use the funding to buy their chips. That's vendor financing, it manufactures an artificial demand signal, and historically, that is a massive red flag. So what's the real alpha here? What's the core takeaway from this explainer? It's recognizing that the NVIDIA premium is totally transient. The general-purpose GPU monopoly is dying, and an open, multi-vendor ecosystem is taking its place. We are firmly in the era of silicon abundance now. The true value is migrating up the stack. It's shifting to the companies that use AI to completely slash their operating costs and skyrocket their productivity. It is no longer about the companies building the physical infrastructure, because those hardware providers are staring down the barrel of a massive margin compression. So I'm going to leave you with this final thought. You might be 100% right about AI changing the world. For sure, it is. But if you are heavily overexposed to the physical infrastructure providers, can your portfolio actually survive the inevitable reversion to the mean when those hardware margins finally collapse? The commodity era of AI is here, folks. It's time to adjust the strategy. Thanks for hanging out with me for this explainer. Until next time, stay curious.